Good afternoon, everyone, and welcome to this session. I want to begin by acknowledging the traditional owners of the land here, the Turrbal and Yagara people, and acknowledge their original and enduring custodianship. Can I welcome you all to this session on the Economic and Market Update. We're running these sessions ahead of our formal annual member meeting in response to requests from members for the opportunity to hear about different topics ahead of the formal meeting. And so this is a great opportunity to hear from our Chief Economist, Brian Parker, who will give his economic update shortly. Brian will share his expert insights, observations on key trends and analysis, and how it informs the broader and longer range thinking for Australian Retirement Trust and the team that are the stewards of your retirement savings. So Brian will give that presentation shortly, and then he'll be taking questions. Before Brian comes along to give the presentation, I'm going to hand over to our Executive General Manager of Advice, Education and Guidance at Australian Retirement Trust, Anne Fuchs, who'll be moderating the session. I hope you find the session informative, and we'll see you all here a bit later on as well. Over to you, Anne.
Good afternoon, everybody, on this rainy Brisbane afternoon. And I note that a few of you have decided to stay home and probably are watching this in your PJs, and I don't blame you. It's one of the good things maybe that came from COVID. It's the ability to be able to dial in online and engage. So it's great that those of you who are in the room, we really appreciate you coming along. And Andrew's right, many of you, our members, are so keenly interested in all things the economy and investment markets and how it impacts your very, very precious retirement savings. And that's what Brian, our Chief Economist, is here to talk about today. Now, of course, you'll know that this is general information only. We're not factoring in your personal circumstances and needs. If you want more information, of course, going to our website's a great place to start, where there's lots of information and calculators. I'll do a shameless plug for Super Insider, those of you that don't know our series on all things the economy, investing, retirement strategies. You can watch some of those to get more information. You can contact us through the normal channels as well if you're wondering what to do. And if you need some financial advice, we're here as well for that. And if you have your own advisor, talk to them. So just remember that today. Now, I do have some important housekeeping to get through, so I will follow the instructions. If you can bear with me, I'll read these so I don't miss anything. So for those of you online, to see the full screen with closed captions, scroll down, move your mouse towards the bottom of the screen for the navigation bar to display, and then you click on the full screen icon. And if you have any tech issues, please don't worry, we are here for you. First, try refreshing your browser, and if that doesn't work, then you can email us at events@art.com.au. That's events, events, at art.com.au. Now, following Brian's update, there will be time for questions and answers, which is really exciting. It's like Super Insider is live, coming to you live today rather than being in a podcast studio. So there will be plenty of time to ask questions. I do want to let those people know online that if you're putting in a question, the full name that you've registered with will be displayed unless you want us to hide your name. And so if you're typing in a question, make sure you type in the word hide at the start of your question, and that way only your first name will be published. Now, for those that attended the previous sessions earlier on, thank you so much, and we hope you enjoyed it and it gave you more information and knowledge about your retirement savings. Those episodes or those sessions will be published on the ART website soon, along with this session, Economic Update with Brian. So the man that brings, I say, a bit of showbiz and personality to economics, Brian Parker, our Chief Economist Extraordinaire. Welcome to the stage, sir, and we look forward to hearing your economic insights. Thanks.
Thank you very much, Anne, and thank you very much, everybody, for coming. It's great to see you all here. It's so nice to actually do a member session actually face-to-face instead of sitting in a small 3x3 cupboard at home in front of a laptop. So it's great to see everybody here. Let me start with some main messages, and that is that, you know, if you were in a room full of economists about a year and a half, 2 years ago, firstly, you have my sympathy. Secondly, those economists probably would have said to you that a recession was highly likely. certainly in the United States, but also elsewhere. And the reason they would have said that was that because we'd seen this massive surge in inflation, cost of living pressures, not just here in Australia, but around the world, in the immediate aftermath of COVID, those economists would have said, you know what, it's very hard to bring inflation down without inflicting at least some economic pain. And yet a year and a half, 2 years later, we haven't really seen that recession. The global economy has actually held up remarkably well. Inflation has come down. In fact, it's come down far enough and fast enough to allow at least some of the world's major central banks to start cutting interest rates. Not ours. We think ours will be last cab off the rank. We don't see the RBA moving until maybe May next year. And even then, only reducing rates a little bit. On the inflation side of things, yes, we have seen a good deal of progress in bringing inflation down. But in a lot of places, it's still uncomfortably high, including here, especially when we look at the price of services, as well as, in the case of Australia, a lot of regulated prices as well, things like utility bills and the like. But nevertheless, we do think the RBA will have enough latitude by the middle of next year to start cutting rates. It's worth also talking about the state of the world more generally. You know, the world is a very uncertain and very volatile place. There's no point in trying to sugarcoat that. In fact, there's no point in someone like me getting up at a forum like this and ever doing that. We need to acknowledge that the world is a very highly uncertain place, geopolitically, economically, and there's a lot of uncertainty out there. It's a theme I'm going to return to as we go through. Certainly geopolitics, you know, it's not just what's happening in the Middle East or in Europe, but potentially what may happen in our own region or anywhere else. On an ongoing basis, this is still likely to cause disruption, not just to financial markets, but to the economy as well. Again, it's a theme I'm going to return to. Now, despite that very uncertain backdrop, if I actually look at investment returns, and so this chart is just going to show what the major asset classes have delivered for the financial year ended 30 June. Okay, so I'm going to start by showing you what the more defensive asset classes have done. So the returns from bonds and the returns from cash. Now, after a few years where bond returns were negative, it was actually a very poor period for bond investors, and also a period where the returns from cash were pathetically low. Why? Because the central banks around the world reduced interest rates to near zero, and so cash returns were next to nothing. We've actually seen a significant improvement in those returns in the last year or so. Not necessarily means that bonds are totally out of the woods, but certainly last financial year was a better time of it. But realistically, the best place to get returns last little while was share markets. There's an old adage that share markets climb a wall of worry. And that's certainly what we've seen in the last few years, where Australian and international shares, particularly international shares, have done extremely well. Okay? And so the greater exposure you had to share markets, the better the investment returns were. Now, why was that the case? Interestingly enough, when you go through an environment where the economy keeps on growing, interest rates start to come down and inflation starts to come down, that creates pretty much a Goldilocks kind of environment for financial markets. And it certainly showed up in the returns over the last year or so. Those better cash returns that we see on that chart, 4.4% for the year to June, came about because the world's central banks raised interest rates very aggressively. Now, this chart just shows you the Australian Reserve Bank cash rate, but also equivalent interest rates as set by the central banks of the world over a range of years. In fact, you've got to go back decades to see a similar period where the world's major central banks raised interest rates as far and as fast as they did. They've started to come down gradually, and that's good news for borrowers, but it also means that the returns from cash will probably start to come down a bit as well. Okay? Why have interest rates started to come down? Because inflation has started to come down. This is just core or underlying inflation rates in the major economies plus Australia. And you can clearly see that after that massive surge in inflation after the end of COVID, that inflation rates have started to come down. It doesn't mean that prices are falling, they are not. But they are certainly rising at a significantly slower rate than they were. And interestingly enough, we've been able to achieve this without anything like the kind of economic pain that a lot of those economists you were stuck in a room with 2 years ago would have said. In fact, if I look at how the world has been faring, and what I'm showing you here is just economic growth rates, GDP growth rates around the world and here in Australia for 2023, and also the latest forecasts for 2024. which will probably be a little bit accurate given that we're only about 5 minutes away from the end of the year. So the world economy, despite the fact that you saw interest rates go up a very long way, the global economy has continued to grow at a fairly healthy clip of close to 3%, underpinned by very good growth in the United States. If anything, growth in the United States has been better in the last 12 months than we saw in the previous year. So the US has certainly defied a lot of predictions of recession. Not so, bit different though, Europe is still kind of struggling. Europe's growth potential isn't all that flash, but they've had a bit of a better year this year than last. Japan, the complete opposite, had a very, very strong 23 and are likely to just barely grow this year. Now here in Australia, we've certainly seen growth slow down this year. And yes, we are still growing, but a lot of that growth reflects very, very strong population growth. And that's a theme I'm going to return to as well. And also, crucially for our own economy, growth in China has slowed down. Now, growth in China of around sort of 5% or so, that's rather weak by their historical standards. But again, it's probably better than a lot of people thought China could achieve, given some of the structural problems that China has. Very, very weak demographics, slower productivity, a terrible property market, lots and lots of debt. So there's lots of uncertainties there in China. Now, let me talk a bit about Australia in a bit more detail. Firstly, let's go to confidence. Now, this just shows you measures of business and consumer confidence relative to a longer-term average. So what I've done to try and compare apples with apples is I look at the level of confidence compared to the average level for the decade leading up to COVID. Okay? And what it's showing you is that after a period where confidence, especially for consumers, was actually quite depressed. In fact, even though the labour market has been pretty strong, people have been getting fairly decent wage increases, finally, despite all of that, consumer confidence was about as bad as it was during COVID. In fact, nearly as bad as we see during, when we saw during the early 1990s recession. And that was kind of puzzling. And a lot of that comes down to these inflation and cost of living pressures. Yes, things have started to improve, as you can see on the chart. But it does suggest that, even though the economy wasn't doing as bad as some of these confidence figures would suggest, people were still feeling the pain. And as I said, a lot of it comes down to inflation. Now, I want to do a bit of a thought experiment, if I might. Now, for the record, I am 57, okay? I know I don't look it, but I'm 57, okay? And I want you to think back over the course of your life. And I think the average age in this room will be probably around the 60 mark, I'm thinking. I want you to think, when did you first become, I'll call it economically aware? When did you first, how old were you when you first became aware of the price of stuff? Or how much you were earning relative to the price of stuff? Or what you had to pay for things? It might have been, when you first got, money from the tooth fairy, or it might have been when you started your first job at Macca's or something like that. But my point is that if you became economically aware at any time since about 1993, then the last few years has been your first experience of high inflation. This is your first rodeo when it comes to high inflation. Because around the world and here in Australia, we had a 30-year period where inflation was pretty much within the Reserve Bank's target band, 2 to 3%. And you didn't really have to massively change your behaviour to try and get ahead of price increases. Because, and in fact, inflation didn't really feature into a lot of people's day-to-day economic thinking. It didn't affect people's confidence that much. But the last few years, it clearly has. Now, as I said, for people of a certain demographic, this is their first rodeo. This is their first experience of inflation, and it certainly has showed up in the confidence numbers. It showed up in people's spending power as well. More about that in a minute. Now, I should, for the record, say that my first experience of inflation is a bit different. That's my first experience of inflation back there. Now, back there, I was 6 years old and I was in grade 2 at St Vincent's School on the Gold Coast. And this is in 1974, and the price of a chocolate paddle pop went from 5 cents to 20 cents in 6 months. Now, that is pretty much hyperinflation for a 6-year-old, right? That is like living in Zimbabwe, for God's sake, okay? So that was a massive inflation shock. But, certainly my kids, who are now in their early 20s, this is their first experience of the cost of inflation becoming a big deal. But the good news is inflation has clearly rolled over. A lot of the commentary about the Australian economy as well, very much when you talk about growth and you say, yeah, the economy is growing, But you hear a lot of commentators say, yeah, that's true, but on a per capita basis, it's not. So things like GDP per head, output per head, or income per head has not been growing at all. In fact, it's actually been shrinking. So what I'm doing on this chart, this is a combination. What this chart really shows you is what sort of impact population growth has had, but also the impact of higher inflation on people's spending power. Okay. So what I'm showing you here is the annual rate of growth. It's a financial year basis. The annual rate of growth in real household disposable income. Think about it as it's a measure of how much stuff you can physically buy with your income. And what it shows you is that the last 2 financial years, you've seen that real purchasing power shrink. And in fact, you've really got to go back to the early 1990s recession to see anything like that. In fact, on this measure, it's actually worse than we saw during the early 1990s. So it's a little wonder that people have certainly got a bit concerned. Now, I did also mention this, we've seen this very rapid population growth, and that's also causing a lot of stress as well. Now, normally, if you basically work on the assumption that economic growth is driven by population growth or labour force growth and productivity, having a faster rate of labour force growth, provided you can accommodate that labour force growth, and provided you've got the infrastructure to do it, that's actually a good thing. But unfortunately, post-COVID, when our borders reopened, we quickly demonstrated that we remain a very favourable destination, a very attractive destination for long-term migrants and international students. And so this is a rolling 12-month total of net long-term arrivals into Australia. And what it shows you is that at an annual rate of about 500,000 a year, that is a massive surge in population. In fact, the fastest population growth we've seen in Australia since the baby boom, since the late 50s, early 60s, okay? Quite extraordinary. Now, sadly, we chose this time to start building fewer homes. So what this next chart shows you is the number of new residential building approvals, the number of new homes we decide to build per head of population. And again, it shows you that the number of new homes we're building relative to population is about as low as it ever gets. You could not have timed this worse if you tried. Now, the solution is actually pretty clear. You need to build more homes. But unfortunately, finding people who actually can build the homes is a bit of a challenge, given that a lot of the construction firms, a lot of the engineering firms, a lot of the tradespeople are all tied up doing infrastructure projects. So finding someone to actually transition into doing residential is really, really hard. So it's hard to see this changing anytime soon. Now, I want to chat a bit more about longer term trends, and then I'm happy to take your questions. As an investment team, there's about 130 of us now. We don't actually spend a lot of time worrying too much about how the economy is going to fare in the next month or 3 months or 6 months. Mostly because nobody can predict it, but also because we are managing long-term money. It's a theme again, I'll return to that. But we do worry a lot about how the economy and how financial markets are going to play out over the longer term, 3, 5, 7, 10 years and beyond. And we worry about the kind of factors that are going to drive the economy and drive markets over those sort of time periods. And so let me just summarise some of the thoughts that we've been grappling with of late. We think that we are clearly going to go into a more volatile world economy, whether it's because of the ongoing impacts of climate change or geopolitics. We are in a more volatile world. And that's not just something we worry about on the newspapers, it has implications for markets and for the economy. We are in a less globalised world. Globalisation, if you measure it by the volume of world trade relative to the economy, that peaked about 15 years ago. It's gone pretty much sideways, but what you are seeing increasingly is global businesses and governments rethinking global supply chains, rethinking where they source raw materials, rethinking where they buy crucial final products. Back in the day, when basically globalisation was in full swing, you could source the cheapest supplier for anything you needed from anywhere in the world, even from a country that didn't like you very much. Because business is business. That is now changing, okay? What it also means is that longer-term downtrend in inflation is behind us. We need to get used to the idea that inflation and interest rates are going to be a little bit higher. That does not mean we're going back to the 1970s, not at all. The 1970s was a disaster for fashion, for music and for money, in that order, right? But we are going into a period where central banks, instead of battling to get inflation up, they're going to be battling to keep inflation under control, okay? This is this globalisation story. This is the value of world trade as a share of global output. And this goes back to the early 1960s. You can see that there was a long multi-decade uptrend as the world opened up. It was given a massive kick along when China entered the world trading system. But that trend came to an abrupt halt 15 years ago or so. It means that we need to, as investors, we always need to worry about inflation. We always need to worry about generating real returns. When you pick up a PDS, when you pick up our prospectus or product disclosure statement, and you do something remarkable, you read it, there's lines in there which say, this is the return objective we're aiming for. And it's always couched in terms of real returns. It's the return above inflation. So I want to share with you some data on that. This is the return, this is the rear view mirror, right? Rear view mirrors are not as useful as windscreens, but they're still kind of useful. Right, so this is the rear view mirror. This is the suite of diversified options that we run. And this is what they've delivered over the 10 years to the end of June. That's the blue bars. The red bars show you what we said years ago we were aiming for. Those red bars basically say, you know what, over the next decade, these are the returns that we think are realistic and achievable and sustainable. And if we do better than that, great. But fundamentally, that's what we're aiming to achieve. And what it shows you is that most of these options have exceeded that objective comfortably. That tells you two things. One, it tells you we're pretty crap at forecasting this. But secondly, it also tells you something more important. Over that decade, the markets have been kind. That any crisis was relatively short-lived. That, you saw lots of market ups and downs, but generally speaking, the market returns were strong. A rising tide lifted all boats. We think the next decade is probably going to be a little bit different. Now, what underpinned those very good returns? The markets were strong. So what this chart shows you is the major assets that we invest in on your behalf. Both the public markets, like shares and bonds, but also the private assets, like private equity, infrastructure, real estate, okay? And what it also shows you is, I've got inflation there as well. A couple of things I wanted to point out. Share markets have absolutely shot the lights out. That over the last decade, it was a phenomenal period to be a share market investor. It also shows you that returns from bonds and cash, both Australian and global government bonds and cash returns, were below inflation over that 10-year period, okay? It just reflected how low interest rates fell, particularly during that COVID period. Now, that's the rearview mirror again. But every year, our strategy team goes through a very, very major exercise where we rethink our strategic asset allocation. And as part of that, we need to come up with longer-term assumptions about returns and volatility and the range of uncertainties out there that we're going to be facing. And we use these longer-term return assumptions to allocate funds across different asset classes. I wanted to share with you the latest numbers from that effort, okay? This is the red bars. A couple of observations here. Firstly, to the far left there, shares over the next decade are not likely to be as friendly as they were in the last. We think share market returns are going to be more modest, okay? Secondly, the returns from bonds and cash are now going to be considerably better. Even though higher interest rates have caused a lot of grief for home borrowers, the silver lining to that cloud is that the future returns from things like investment-grade bonds, government bonds and cash are now considerably better. But the other thing I wanted to call out is some of the lines in the middle. Infrastructure, real estate in particular, and private equity. We expect that these unlisted or private assets will still deliver a return premium over time. Now, one of the things two things I just call out is that given that Art is now an investor that manages over well in excess of $300 billion on behalf of nearly 2.4 million Australians. When you're managing that kind of money, you need the broadest range of opportunities you can find. Not just what you can find here in Australia, but globally, and not just what you can find on the stock market, but a whole range of both public markets and private markets, especially assets like real estate, infrastructure, private equity, where because they're not listed, they give you a premium return. Because anything we can do to guarantee, I don't want to use the G word because I can see Liz Hallett from the board giving me the bad eye for using the word guarantee. But anything we can do to tilt the odds in favour of delivering the kind of real returns we all need, that's got to be an opportunity we're taking. And so this is where the private assets come into play. I wanted to share with you some of the assets that we hold. One of the really cool things about this merger, especially from 1 July this year, there is no longer any such thing as a QSuper asset or a legacy Sunsuper asset. They are art assets, which means that assets that were previously owned by one or either fund are now owned by all art members. Heathrow Airport, an iconic airport. Now, clearly airports have been challenged during the COVID period, but what we're seeing now is a very, very strong recovery in passenger numbers, and it's showing up in double-digit returns from our airport assets. And having been through Heathrow Airport about 4 or 5 months ago, I can tell you it's back to being the crap fight it always was. So passengers have recovered, which is great. And we own about 11% of this asset, okay? And we have our people on the ground managing it on your behalf. The G'day Group was a art super savings and legacy Sunsuper asset, one of Australia's, if not Australia's, largest operator of holiday parks. We own the lion's share of the equity. Art members get a discount when you stay there. That's the Harvey Bay Park. It has the best holiday park sites in the country. It also is continuing to grow and acquire iconic holiday sites such as El Questro in the Kimberley and Kings Canyon, a beautifully managed asset. The people who manage these parks and the head office people who manage the business are absolutely passionate about what they do. We've invested in this since 2014. It's given a return of about 11% or so per annum on average over that decade. And it's a business that continues to grow with us. And as I said, as ART members, you do get a discount. Do check out the website for that. Another one, aged care. There remains a significant shortage of quality aged care facilities in this country. And that shortage is only going to get worse unless capital can be allocated to providing more facilities. We've been investing in aged care via a vehicle called Carnegie Catalyst for about the last 7 years or so. We now own 13 aged care facilities, either in operation or under construction, across the country. We will continue to invest in more, provided we can find the right partners who can then manage facilities properly and also attract and retain the right staff. Absolutely crucial, okay? That's the Odyssey facility down at Robina, okay? So far, since we've invested, these have delivered returns of about 9% per annum. Not just that, they've delivered returns of about 9% per annum really reliably. Because regardless of what happens in the stock market, or regardless of what happens in the bond market, aged care residents are still going to need a bed, and there's still going to be an income to be generated from owning these assets. And we think that's important. Can you meet a social need and still generate commercial returns? Yes, you can. Okay. And I know I don't want to sound too corporate, but when businesses talk about synergies, I want to give you an example of one. Retail property, retail investing, especially with COVID, copped a bit of a bad rap. There's this idea that you wouldn't want to be investing in retail because everybody's working from home, they're online shopping or whatever. Now that's partly true, but there are certainly sections of the retail marketplace that are continuing to do really well. And one of which is the town centre model, of which Robina on the Gold Coast is a prime example. We have about $2 billion invested in these town centre model shopping centres around the country. And their occupancy rates are averaging about 98%, and they're doing fine. So, you know, the death of retail is greatly exaggerated. And in a bit of synergy there, the little blue arrow I've got there, that's our Odyssey house facility at Robina that I showed you on the previous slide. Thankfully, it's about a 5-minute walk or a 3-minute scooter ride from Robina Town Centre. That is synergy for you, okay? So these are the kind of assets that we hold on your behalf. And I just want to finish by sharing with you some messages that we try and get across to people, especially when we go through challenging periods in financial markets. Whenever you see financial markets go through a bad period, our contact centre staff get hit really hard, and they often reach out to people like me and the team I work with and say, can you give us some words that we can share with our members to explain what's going on and what members should do about it? And so this is what we do. Often these messages are the same. Firstly, to acknowledge that superannuation is still the longest term investment any of us are ever going to have. And before someone says, but what about my house? My response is, you can't eat the walls. Okay? Your house is a consumer good. You consume the service it provides you, i.e. shelter. An investment property, different conversation. But super is probably your longest term asset. We don't, even though I'm an economist by trade, a bunch of the investment people I work with are also trained economists, but we don't invest money based on our ability or anybody's ability to forecast how the economy is going to play out in the short term, because nobody knows with any confidence. Nor can we predict how geopolitical events are going to play out. No one knows how give you an example. I think the general consensus was that the war in Ukraine would be over in a week, that the Russians would just storm in, and then they completely underestimated the resolve of the Ukrainians. We don't know how these events are going to play out. We don't know how events in the Middle East are going to play out. What we also know is that crises, whether they be economic or financial or geopolitical crises, are inevitable. Recessions are inevitable. Market downturns are inevitable. Crashes are inevitable. They're part and parcel of being a long-term investor. Over the course of anybody's working life, there's probably going to be 4 or 5 recessions you have to go through. There'll be a number of major market downturns, maybe 10, 15, 20 major market downturns. I don't know, pick a number. Or a range of geopolitical flashpoints. But one thing we also know is that even though they are absolutely inevitable, they all have one thing in common. They come to an end, bar none. Every crisis, every bear market, every recession, every downturn comes to an end, bar none. There is always a light at the end of the tunnel, and it's not a train, it's the end of the tunnel. And so I just think it's worth remembering that. But it's also worth remembering that everybody's different. Some people have a longer investment horizon than others. Some people have greater financial resources than others. Some people have a greater need and desire to take risk than others. Some people want to and need to invest more conservatively. It's horses for courses. And if anyone actually needs to find out, well, what kind of investor am I and how much risk should I be taking? Or how much risk should I be comfortable taking? Because at the end of the day, we all need to sleep well at night. Sleeping at night can never be overrated. And if you need help actually answering those sort of questions, please, please, please get in contact with us and seek financial advice. Because what we've also found, and Anne will testify to this, those of our members that seek financial advice tend to get better outcomes in retirement than those that don't. And with that, thank you again for listening, and I'll hand you over to Anne. Cheers.
You're there?
I'm here.
That indeed is no word of a lie. I can attest to that. So I do have a couple of housekeeping matters to go through again before we get into the Q&A. And thank you, Brian. That was very, very informative. Now, for those in the room that have questions for Brian, if you pop your hand up and we'll bring a microphone to you and you can ask your question. And if you're online, you can submit a question via the panel to the right of your screen. Click on the right-hand navigation to open the Q&A and then you can submit your question or you can vote for somebody else's question. And again, don't forget, if you don't want your full name published, to please type the word hide so that we're not publishing your full name and we'll just put your first name. We'll try to get through as many questions as we can with the time that we've got, and we're going to prioritise economic and investment markets ones, and we can't talk about anyone's personal circumstances, just to remind you. But we might crack on because we've got some enthusiastic members in the room.
Hello, just 2 questions. The first question is, at the moment, with the shares assets, listed assets, we can choose Australian shares index, international shares index, etc. Is there any option of creating a S&P 500 index? And the second question is, in regards to Australian Retirement Trust investing in infrastructure, is there any thought or possibility you would go in 50-50 with the Queensland State Government to help build a new Olympic Stadium in Brisbane?
Give it a go.
Yeah.
Yep. Firstly, on your first question, given the rapid growth in the... firstly, the way we design the investment menu is we deliberately have kept the menu large enough that you can actually build sensible portfolios with, but small enough so that each of the options will have scale, they'll be efficient and cost effective to run, and will meet the needs of the vast majority of our members. Okay, we don't offer a US S&P 500 alone, but one thing I would say is that because of the very strong growth of the US equity market, if you invest in the international shares option, US equities are now 55-60% of that index. So you already have a very significant allocation to US shares. But we also think that, I don't think that if you're building a properly diversified portfolio, and I acknowledge that some people may want a US-only portfolio, but we just think that we will meet the needs of a wider range of members and give members a more diversified outcome if we offer an international option, not just a US option. And on the infrastructure side of things, every investment decision we make, every one has to be incredibly hard-nosed. It's basically, can we generate a return that is more than adequate for the cost of making that investment and the risk involved in that investment? We will never compromise on that. Now, is there from time to time, opportunities to partner with like-minded funds or potentially governments to facilitate an investment? Potentially there is, but all of those decisions would be assessed on their merits. There would never be any sort of agenda there. One thing I would say though, and this is from experience in a former life, or actually several former lives ago, just from an investment standpoint, I'm not sure sports stadiums have actually been a recipe for success. A former shop I worked for, we did make a small allocation to Docklands Stadium in Melbourne. And that's a pretty busy stadium. But unfortunately, it's not busy enough on a daily basis to generate enough revenue per day to really generate the kind of returns you want. So I personally would be a little sceptical about those sort of investments, but we would absolutely assess any investment opportunity on its merits. If it's stacked up, happy to have the conversation. If it doesn't, we walk away.
Okay, good. So we're going to take one online, then we'll go room, if we'll go back and forth, if that's okay with everybody. So I've got a question here from Diane. Brian, why do you not invest in gold bullion in the portfolio and silver?
Oh, look, that's a good question. We do have a very small allocation to commodities as a bit of a diversification, but also to give us maybe some opportunity to increase our exposure if we saw that opportunistically. We do absolutely have exposure to gold mining companies, for example, where you're going to get a dividend and they're going to benefit from a higher gold price. But we've tended to find that, even though, firstly, gold as an asset, yes, it can play a role in a diversified portfolio, but we just think that in terms of the returns you're likely to get longer term,
The cost of storage?
Cost of storage, I suppose, but that's doable. You just use futures to do it. But we just think we're going to get a better return by allocating capital to businesses that generate an income and can grow an income over time, whether they be listed or private equity, private businesses or infrastructure assets or properties that will generate an income stream and an income stream that's going to grow. And unfortunately with gold, because of the nature of the beast, it tends to be quite speculative. You can look at how it behaves over time, and there are certain scenarios where gold makes sense, but not always. It's very, very hard to analyse and very hard to work out. And I'm conscious that, yes, it's very easy to say, well, gold has done brilliantly over the past decade. We should have been in gold. Yeah, well, a lot of things have done really well over that time, so we're not really missing out on that much.
And I will plug the last episode of Super Insider where our Chief Investment Officer Ian Patrick is also talking about why gold as an asset class. So that's the most recent episode of Super Insider. So give that a listen to as well, Diane. Mm-hmm. Now, Steve, I see there's a question over from a member. Hello.
Hello. Can you hear me?
Yes, we can.
Okay. This is also macroeconomics, really. I was just wondering, what does ART consider will be the impact of a resurgent Chinese economy on the Australian economy, and what factors will determine this impact, including the US Federal Reserve monetary policy?
Yeah, first, there's a lot to unpack there. Firstly, in China, clearly, if we were to see a resurgent Chinese economy, that directly does benefit Australian exports. It benefits the whole region. So there's also regional spin-off effects which benefit Australia as well. However, I think we also need to acknowledge that China's best economic growth years were the last 20 or 30, not the next 20 or 30. That, you know, China's demographics are now very poor. You've got a shrinking labour force, much slower productivity growth. They've had a massive investment. They've got a hugely oversupplied property market, a lot of excess debt related to that. That is going to take some time to unwind, but any efforts by the authorities to improve China's growth prospects is good news for Australia. In terms of the Federal Reserve and what's happening in the United States, the US as an influence on the Australian economy is not what it was. So if we were to see the Federal Reserve, I think you mentioned raising rates. If to the extent that they take steps to boost growth by cutting rates, that is generally good for the world and good for the Australian economy indirectly. But one of the things we do worry about is that, if you were to see, for example, a bit of a surge again in inflation in the United States for a range of reasons, what would the Federal Reserve do in response to that? If the Federal Reserve looked at that and said, hang on a minute, we were cutting rates because inflation's coming down, if they look at that surge and say, oh look, it's kind of temporary, so we're prepared to ride this through, that wouldn't necessarily be bad. But if the Federal Reserve says, hang on, we need to address this, we're going to be raising interest rates again, then that's potentially quite adverse for the US economy and for the world. But we don't know exactly how that's going to play out, is my point.
Now, Brian, my friend, we are getting so many questions, which is very exciting and cool. So let's try and, we can try and get through as many as possible.
You need me to be brief.
Well, let's do. Okay, so
no, brevity is not a strong point.
Okay, no. Good. Okay, so I'm going to throw one online, and it's from Bradley. Why does ART promote being ultra-conservative leading up to and beyond retirement when its members can live on for the next 20 or 30 years, which is long-term?
It is, absolutely. And look, if I think about the default option we run, the life cycle default, we have just moved to raise the amount of growth asset exposure, such as share exposure, because we're absolutely conscious that our members are going to be living longer. And we also did that for our younger members because we wanted our younger members to get more of a kick along earlier in their careers. But we also want to be very, very careful about how much risk. Now again, the ideal portfolio, as Anne will tell you, the ideal portfolio for everybody in this room is someone that you have built that fits your needs with the aid of professional financial advice, either from us or from your independent financial advisor, because it is horses for courses. So some people will need a more conservative approach when they approach retirement. Other people will say, no, I'm prepared to really, try and hit the ball for six, and they're comfortable taking more risk. But when we think about our life cycle defaults, we need to act in the best interests of our disengaged members. And so we think gradually reducing your exposure to risk, still have some exposure, don't get me wrong, because we all do hope to be living longer, but we think that gradual reduction in risk as you approach 65 still makes sense for the great majority of members in that default. Full disclosure, that's where I am, because I think we should eat our own cooking, frankly.
Indeed. Michelle, I see you have a question over there.
Brian, my name is Pat. My question relates more to 2 questions ago than the last one. I heard what you said during your talk on geopolitical issues. Yep. My question is, what effect do you think, what impact will Trump's victory have on our returns over the next 5 years? Would we be better off under the Democrats or the Republicans in your view? And what effect has that had, or how have you planned for that? What changes do you think you will need to make in order to accommodate that result?
Good question. When you were asking the question, I just looked at our directors at the front of the room. And
the T word. And
I can actually answer the question. Firstly, we have spent some months analysing the likely scenarios under a red wave, a blue wave, a split White House and Congress. What we've come to the conclusion, firstly, we've come to the conclusion that, look, we don't know exactly what Trump will do. We don't know. He's a very unpredictable beast. He likes that. He's very transactional. He likes the uncertainty. He likes the unpredictability. He thrives on it. Okay. And when we think about what might happen over the next little while, certainly share markets have taken a Trump victory positively because they see it as he'll stimulate growth through tax cuts. He'll be more in favour of deregulation, and they see that as equity market friendly. We have no idea how long that sentiment will last. What we've also seen is a rise in bond rates, a rise in the yield on government bonds, because what the markets have also said is, look, he's probably going to impose tariffs. That almost certainly means higher inflation. That could cause some risks, and it might cause the Federal Reserve to potentially change course with rates. We don't know exactly yet. But what we also know is that, and your question, I'm glad you said a 5-year view, because a lot of those impacts we think are likely to be temporary. So let's say, for example, that he does impose tariffs, he does boost the economy, and you do get an inflation surge. We don't see that as being a permanent state of affairs. Now, what can we do in response to it? We can certainly be prepared to take advantage of it in some ways. So, give you an example more recently, that rise in bond rates now means that if we buy bonds today, the future returns are a lot better. So we've taken advantage of that, and we will continue to take advantage of any volatility that his policy regime may bring about. And the reason we're able to do that is that because we are operating with a time horizon of 3, 5, 7, 10 years and beyond. Now, thankfully, there are only 4-year terms, and so who knows what would happen next time. When you look at the history of these things, there's no evidence necessarily that a Republican administration or Congress is better for business than a Democrat one. Share markets tend to do well regardless. And I think that's the other takeout. And just one final point, because I know you said it would be brief. I'm sorry. Anyway. Don't underestimate the United States as an investment destination. The political system may be a complete disaster, right? It's been dysfunctional for years. But let's distinguish between the US political system as a disaster and an economy which is the largest and most dynamic and innovative in the world. With, some of the businesses that have come out of the United States are the best in the world at what they do. So are we still happy to invest in a range of those businesses? Yeah. They're world leading. And also, even a lot of the private asset work that we do, whether it's in real estate or infrastructure, a lot of that activity and the regulatory environment that affects it very much happens at the state and local level, regardless of what's happening in Washington. So distinguish between the US as an investment destination and US politics, which I agree is somewhat challenging.
So we've got a great question online around unlisted assets. A question, you and I have done many of these over the years, and I've never seen this question before, so I'm going to ask it.
Okay.
So sit up and listen. Okay, good. So how do you manage the risk of selling private assets when there are no buyers?
Oh, it's a really, really good question. Well, firstly, if there are no buyers, you don't, quite obviously. But what we've been able to find is we don't necessarily, when we go into a private asset, like a piece of infrastructure or a major real estate asset, you don't go into it thinking, I'm going to flip this in 3 years. These are assets that we buy with a view to basically holding them for many years and enjoying the income stream and enjoying that growing income stream. So we're fairly sanguine about the time horizon of those assets. So that's not to say we'd never sell, because what we've certainly seen in the last few years, or the last decade that I've been here, we've just had the opportunity to just opportunistically offload some assets just because someone has come to us and offered us a crazy price that is miles above what we've had it valued at. Now, if a wood duck like that comes in through your door, you have to have the conversation. And so, if you can actually opportunistically offload an asset, bank some really nice profits for members, reinvest the capital somewhere else and generate a better return, happy days. But we're not particularly, we don't feel the need to sort of offload assets in a particular time frame.
Okay, good. Now we've got, thank you. Thank you, Brian.
Was that brief enough?
Yeah, that was.
Thank you.
Michelle, another. Oh, we've got Michelle up there. Then, okay.
One of the bottom. Yep.
And quite a few.
Hello, Brian and Mandy. So I have a question for you. to elaborate a bit about the per capita GDP decrease on the investment return prospect?
Yeah, I think what we're likely to see, there's a lot to unpack in that question. You've certainly seen an economy here in Australia which has been much weaker in an underlying sense than the headline figures. And the reason I say that is that, you know, over the last few years, the income and spending that we've done on a per head basis has been falling, but the total amount of spending and the total amount of output we produce has been bigger because there's more of us. Very, very fast population growth has propped up those numbers. Now, what we're seeing in the data is we're seeing population growth roll over and slow down a little bit, but it's still pretty robust. But what we're also seeing is, and you saw it in the consumer confidence figures, consumers are starting to feel a bit more confident, which means that you should start to see a bit of better news on things like retail sales and consumer spending as we go into Christmas and the new year. I don't think it's going to be brilliant, but it's not going to be dire. Now, in terms of how that translates to investment returns, that's way more complicated in a way. It certainly means the Reserve Bank is going to be very, very cautious about cutting interest rates, which means cash returns will probably hold up for a bit longer than we might have thought. It also means that a lot of domestic companies might get a bit more support courtesy of that resurgence in consumer spending. But the other thing though is that it's very, very hard to say, this is what I think about the Australian economy and this is what it means for the stock market. In fact, it's almost impossible to do that because quite often, you know, the correlation between the performance of the economy and the performance of the stock market is pretty low, or can be very, very low, especially for a country like ours where so many of our big companies are big global businesses like the big global miners. So the Australian economy might be kind of ordinary, but they're doing fine. So that's kind of how we're seeing things, but I acknowledge that I haven't answered your question properly because it's very, very hard to do. It's hard to translate what's happening in the Australian economy to investment returns overall, especially when we run a very global portfolio. We've money invested everywhere.
All right, Punchy, one for me. Prasantha's asking, and you can do this one, Punchy, I know it. Have you looked at the prospects of investing in data centres with the advent of AI?
Yes, and we've made a lot of money in data centres, and we've made initial investment in Switzerland, where we invested, where the major tenant was Microsoft. They kept paying their rent, happy days. And then someone offered us about double what we paid for it within about 2 years, so we sold it. That was opportunistic. Yeah. And more recently, you might have read in the press about a business called AirTrunk, which is a major data centre, Asia-Pacific operator. We made a massive amount of money out of that. Opportunistically, we were able to sell it and bank large amounts of money. We'll continue to invest in data centres, but we'll be very opportunistic about it.
Okay.
My Benoa High School education didn't give me a great economic awareness, but Expo, for the record, it was probably Expo where hot dogs were $2.50 each and never recovered from that in 1988. Wanted to ask what the investment team does when it comes to our shareholdings. I wanted to ask, for instance, we've got a lot of Commonwealth Bank shares. They've reached like $155 a hit now. And does the investment team like hang on to that sort of thing for the dividends, prefer to keep the large amount of shares for the dividends it'll pay, or happy to sell when it gets to that sort of level?
Oh, it's a really good question. I mean, generally speaking, the way we build equity portfolios, think about it as two bits of it. One is a passive component, where we're just trying to replicate the underlying equity market. So we are going to be a long-term investor in Commonwealth Bank and every other major company in that index. So we're always kind of going to be there. And your point about dividends, and yes, if I can continue to get a growing long-term stream of dividends from companies like Commonwealth Bank, fine, happy with that. But the other part of the portfolio is actively managed. And so we leave it up to a range of external managers that we've fairly thoroughly vetted, who we think actually have some skill, and they can decide, do they want to be overweight or underweight or not in at all particular companies. And so generally speaking, I think they've been a little bit, in aggregate, they've been a little bit cautious about the Australian banks for valuation reasons. But generally speaking, given the nature of the fund that we run, we're always going to be there because of the very long-term nature of the business. But certainly there's always a range of views amongst our investment managers about whether they might like a particular stock or not like it.
Okay, one online. Still got a few in the room. I'm trying to get through them. Does ART invest in foreign currencies predominantly for either risk or for return?
We do, predominantly for, we have a foreign currency exposure primarily to reduce risk.
Okay, excellent.
Yes.
Thank you.
Are we able to return to slide number 19?
Don't know, can we?
If that,
This will be a test.
yeah, okay.
I reckon I can.
We've got it. You commented...
Is that
yeah, that's it. Yeah. And I'm looking at the extreme left-hand side, the blue and the red, for the developed market shares, unhedged. And you mentioned, well, it shows the blue there, that provided the best returns. But it also shows with the red line that you expect it to almost halve in future returns.
Yep.
And I'm wondering, is that through geopolitical, or is it's unhedged? So is it foreign exchange fluctuations? What's the reason?
Yeah, it's not foreign exchange because generally speaking, over a 10-year horizon, we expect the dollar to go up, down, and be a wash, effectively. But basically reflects the fact that, yes, we've had a great run in equity markets in the past, okay, much, much stronger than a lot of people would have thought. Going forward, it simply reflects the fact that we build it up by saying, this is the rate of economic growth, this is the typical return we're likely to get from cash and from bonds, and this is the risk premium we expect to extract from share markets. So we kind of build it bottom up. It also reflects the fact that our working assumption, because of demographics globally, is that the global economy is going to grow at a somewhat slower pace. And so if you think about returns get generated by the economy. So if you think of the economy as a giant pie, the pie grows at a slower rate, therefore the returns from the pie are going to be a little slower. But the other thing is a return of close 7.5% to 8% out of over equities, still a nice premium for taking risk. It's just not as good as it was in the last decade, basically.
Another question, we've got a few in the centre here. The gentleman with the cool leather jacket on, right in the middle of the front row.
That is a cool leather jacket, by the way.
Yeah.
Just curious if there is a moral dimension to the investments. And we don't have to talk about arms industry, but just generally, if there are guidelines in how you exercise them.
There absolutely are. We do run across all our funds a range of exclusions. The most appalling weapon manufacturers and also tobacco manufacturing is a blanket exclusion. Pure play thermal coal for risk management purposes is an exclusion, but that's across the fund. But we also offer, for those members that want a higher standard of ethics or social or governance criteria applied, that's where the socially conscious balanced portfolio comes in. That has a broader fossil fuel exclusion. It excludes a wider range of weapons manufacturing, and so that tends to have, and it also tends to invest with a more positive outlook in things like private equity. So we run in that fund what we call an impact private equity program, where we're trying to invest in companies that make good investment sense, but are also actually going to deliver a good net social benefit. So there is a moral dimension to some extent, but I wouldn't call it a moral dimension. I'd call it a risk management dimension, if I can put it that way. Whether it's climate risk, whether it's litigation risk or whatever, to us, we are charged with delivering the best financial returns to members by law, okay? And for us, that's about generating returns and managing risk. Some of those risks may have a moral dimension, but that's not the first thought. The first thought ultimately has to be the net financial returns to members. That's what we're focused on.
We have one last question, and we're over time. One last quick question, and then...
This is quite quick. You mentioned before that the ART is invested in, is it G'day?
Yeah.
Okay. Now, my question is this, and you get a discount if you go there, blah, blah, blah.
Yeah.
Okay. What about retirement homes? You said we also invest in retirement homes.
Yes.
So I think people will be interested in, if we're a super member, do we get a discount?
It's a good question.
It's
That's
a very,
another
very good
question
question.
we've never been asked before,
We've never been
Brian.
asked
That is
before.
another really... We've never been asked that question before.
That, I suspect the answer is no, but let me explain why. Because it's an unsatisfactory answer, I know. We are the landlord. we are not operating the facilities. That's not our core competency. We go into these facilities as a real estate investor. So the manager we work with, Carnegie, and the Catalyst team, we are providing capital to basically buy and to either improve or to construct aged care, and we then find a provider who will operate that business and work out how much they charge and what services they want to provide. So we are strictly the landlord. So you won't see, for example, the Arts insignia, and you won't have Artie the monster scaring the hell out of grandkids at the front door. We are very much the landlord there, so we don't necessarily set the fees.
Look, we'll call it there. Thank you so much for all the engagement. We haven't got to every question, but we hope that your question was kind of answered in all of this. We've done our best to group them into themes. Obviously, the crew are outside. All of our advice, guidance, education, member service specialists are there. So come out, have a chat with us, and thanks again for coming this afternoon. And for those that are comfy at home, online.